There is a quiet machine moving your money right now, and most people do not understand how it works. That is why it is so dangerous. It does not make noise. It does not announce itself on television. It does not send you a message telling you that capital is leaving one place and entering another. It simply moves silently through the system. And when that happens, people who understand flows can become much richer, while ordinary investors keep staring at the same crowded stocks and wonder why their results are not changing. Right now, money is rotating away from some of the places everyone talks about every day. It is moving into areas many retail investors almost never study. That is an important thing to understand because in markets, being late to a rotation can be very costly. You can spend a year watching the broad index move sideways while a smaller group of stocks quietly compounds. And when the move finally becomes obvious, much of the easy money has already been made. But when you learn to see the rotation early enough, you do not have to gamble on meme stocks, chase a rumor, or pretend you can predict every tick in the market. You simply increase your odds by understanding where the flow of capital is going. That is the principle. The goal is not to be excited, the goal is to be accurate. By the time you finish this, I want you to understand three things clearly: why the largest stocks keep getting larger, why the structure of the index favors them more than most people realize, and how to think through a simple process for following money from one sector to another before the crowd fully wakes up to it. I also want to talk about two areas where money appears to be moving with real force, and the kinds of companies that sit inside those areas. This is not about stock tips. Stock tips are usually dangerous because they make people think about names before they understand the system. I want to do the reverse. I want to start with the system, then the sectors, and only then the stocks. That order matters. When I think about markets, I think in terms of cause and effect. Markets are not random in the way most people think they are random. They are systems made up of incentives, liquidity, policy, fear, greed, leverage, and changing expectations. If you study those forces carefully, you still cannot predict the future perfectly, but you can see which outcomes are becoming more probable. The economy is like weather. There are periods of sunshine. There are clouds. There are storms. There are seasons when everything grows, and there are seasons when only certain things survive. Your job as an investor is not to predict the weather perfectly. That is a bad goal because the world is too complex, and many of the most important events are unknowable in advance. Your job is to look honestly at the weather that is actually in front of you and dress for it. So what is the weather right now? We have inflation that is not behaving the way many people hoped it would behave. We have interest rates that may not come down as quickly as investors wanted. We have governments under pressure, deficits rising, and a political system that often turns to more borrowing and more liquidity when stress appears. We have central banks making difficult decisions. We have geopolitics. We have wars and energy disruptions. We have oil, gas, data centers, supply chains, minerals, and national security all interacting with one another. To many people, that sounds impossibly complicated, but it becomes simpler when you stop trying to memorize every headline and start asking a more basic question. What kind of environment is this? This is not 2021. In 2021, a lot of people believed they were brilliant investors because nearly everything went up. Liquidity was abundant, speculation was rewarded. People could buy almost anything with a growth story and feel smart for a while. That is not the environment we are in now. Now, what you own matters more than simply being in the market. That is a very different world. When the macro weather changes, different sectors need different kinds of clothing. Some sectors are built for falling rates and abundant liquidity. Some are built for inflation. Some are built for energy shortages. Some are built for a world where governments spend more on security, infrastructure, and domestic supply chains. Some are built for a world where the cost of capital is no longer zero. If you use the wrong playbook for the wrong weather, the market does not forgive you. That is why the old instruction that you can buy anything, buy the index, ignore the composition, and everything will be fine is incomplete. It is not always wrong, but it is incomplete. The first principle is that you have to know where you are in the cycle. The second principle is that you have to know where money is flowing inside that cycle. Most people do not look at the market that way. They look at the index, they look at a few famous stocks, they look at the news, and they think they understand the market. But the way money moves today is very different from the way it moved 10 or 20 years ago. Take the S&P 500. Most people think of it as a broad basket of 500 large American companies. In one sense, that is true, but in another sense, it is misleading because the index is weighted by market capitalization. That means the bigger a company becomes, the more weight it has in the index. And the more weight it has in the index, the more money automatically buys it when investors put money into index funds. That is a feedback loop. If one company is 10 times bigger than another company, Far more passive money goes into the bigger company each time money enters. The index pension money, retirement money, ETF money, 401k money, and automated investment plans all keep flowing through that structure. The biggest companies are not just being bought because every investor studies them and decides they are the best. They are being bought automatically because of how the index is built. That is a very important distinction. It creates a flywheel. The biggest names receive more automatic demand. That demand helps support their prices. Higher prices make them even larger parts of the index, and then more passive capital buys them again. This does not mean those businesses are bad. Many of them are extraordinary companies. It means the system has a concentration risk that most people do not understand. When a small number of companies becomes a very large percentage of the index, an investor who believes he owns broad diversification may actually own a concentrated bet on the same few mega-cap companies everyone else owns. That can work beautifully while those companies are rising. It can feel safe, easy, and even inevitable. But when the leaders stop leading, the same structure can trap people. If you are buying the broad index, but the broad index is mostly being pulled by a handful of giant companies, you need to understand that otherwise. You may think you have 500 engines pulling the train when in reality a few engines are doing most of the work. And if those engines stall, the train can slow down quickly. This is one reason sophisticated investors sometimes choose concentrated exposure deliberately. They understand what they are buying. If they want mega-cap exposure, they may choose a vehicle focused on the largest 100 stocks rather than pretending they are getting something different through a broad index. That is not a recommendation. It is an example of a principle: know what you own. Most retail investors do not. They buy the index because it feels simple, and simplicity can be good. But simplicity without understanding can become a hidden risk. The next question is the more important one. If the index is concentrated, and if the market environment is changing, how do you find the places where money is moving next? Most people start in the wrong place. They wake up, they check the news, they look at the S&P 500, they stare at the same mega-cap technology stocks everyone else is staring at. They ask, what is moving today? That is not how the big flows usually work. Institutional money, or what I would call trained money, is not sitting still forever in one crowded trade. It is always comparing opportunity, valuation, risk, liquidity, and positioning. It moves from expensive to cheaper, from crowded to less crowded, from growth to value, from tech to energy, from popular stories to ignored sectors, from what everyone already owns to what is beginning to improve. The point is not that institutions are always right. They are not. The point is that they are trained to look at flows. And when enough capital moves into a sector, prices can change long before the average person understands the story. The mainstream explanation usually arrives too late. By the time the story is easy enough for television to repeat every hour, the early part of the move may already be gone. So the real job is not to predict which famous mega-cap stock will win next week. The job is to follow the money. That means looking at the market as a system of flows rather than a list of isolated stocks. I think of the process in a very simple way. You begin with the macro weather. You ask where the world is right now. Is inflation the problem? Are rates the problem? Is energy the problem? Are supply chains the problem? Are governments spending heavily on defense, infrastructure, resources, or domestic production? You do not need to be a PhD economist. You need a clear map of the conditions. Then you look at sectors. Which areas are attracting capital? Which areas have improving fundamentals? Which areas have strong tailwinds from policy, scarcity, security, or demand? Which areas are being ignored even though money is beginning to move there? Only after that do you look for the leaders inside those sectors. That sequence is essential. You do not start with a stock. You start with the world. Then the sector, then the company. Many investors reverse it. They fall in love with a ticker, then search for reasons to justify it. That is not a decision process. That is psychology. A better process starts by asking what the system is doing. The first area I want to talk about is oil and gas, machinery, services, and infrastructure. This may not sound exciting to many investors. That is part of why it matters. The areas that create the best opportunities are often not the areas that sound exciting at first. They are the areas where capital has to go because the real economy requires it. During a gold rush, the people who make money are not always the miners. Often the more reliable businesses are the people selling the picks, shovels, equipment, tools, and infrastructure the miners need. Energy has a similar structure. There are companies that produce oil and gas, but around them are the machinery companies, service companies, equipment providers, drilling specialists, compressor providers, pipeline builders, LNG terminal contractors, and maintenance businesses that make the energy system function. If the world needs more energy, these picks and shovels companies can benefit without needing to make a pure directional bet on one producer. That is why the sector is worth watching. The world still needs energy. AI needs enormous amounts of energy. Data centers need power, cooling, backup systems, and reliable supply. Industrial activity needs energy. Countries need energy security. And when geopolitical tensions rise, the pressure to build more domestic and allied infrastructure grows. Energy is not just a commodity story, it is a security story. It is an infrastructure story. It is a political story. It is also a capital spending story. When oil prices are strong, when supply routes look uncertain, or when nations become worried about relying on fragile choke points, companies and governments spend money on drilling, storage, pipelines, terminals, and equipment. That spending does not flow evenly to every company. It flows to the firms positioned in the right part of the value chain. Liquefied natural gas is part of this. LNG is one of the major energy infrastructure themes of the next decade. If demand for gas grows and countries want more flexible supply routes, the world needs terminals, pipelines, compressors, export infrastructure, and specialized equipment. That is not a story you can solve with a headline. It is a system. If geopolitical risk rises around major energy choke points, countries respond by asking how to secure supply. They may want more storage, they may want new pipelines, they may want different import and export capacity, they may want redundancy. Redundancy is expensive, but in an uncertain world, redundancy becomes valuable. And when redundancy becomes valuable, the businesses that build and service that infrastructure can see demand rise. One company in that area is Baker Hughes, ticker BKR. It is a large oilfield services and energy technology company. In simple terms, it sells many of the tools, services, and systems that allow the oil and gas industry to operate. It is one of the companies connected to the picks and shovels side of the energy world. What matters is not merely the name. What matters is the setup. When I look at a company like that, I want to understand whether the sector has a macro tailwind, whether capital is moving into the group, and whether the price behavior confirms that institutions are beginning to accumulate. The chart matters, but not because it predicts the future magically. It matters because price and volume reveal behavior. If a stock has been moving sideways for a period of time, building a base, and then breaks above prior resistance on stronger volume, that can tell you something. It can suggest that the balance between buyers and sellers is changing. That is a probabilistic signal, not a guarantee. A good investor does not say, "This must happen." A good investor says, "If this happens, what does it imply? What is the risk? And what do I do if I am wrong?" That is the right mental model. Another company in this area is NPK. It is smaller and more specialized, connected to temporary worksite infrastructure for energy and construction projects. Smaller companies can move more dramatically, but they can also carry more risk. That is why a smaller name must be treated with more discipline, not more excitement. The important pattern is similar. You look for a sideways structure, you look for a clear area where the stock has repeatedly failed. You look for a breakout above that area, and you do not buy just because a stock is mentioned. You wait for the market to confirm that the setup is actually happening. This is where many people misunderstand price. They think paying a slightly higher price after confirmation is irrational. They say, "Why would I want to buy after it goes up? Why not buy it lower?" The answer is that investing is not about getting the lowest possible price in a vacuum. It is about getting a favorable probability distribution. A lower price before confirmation can be cheaper for a reason. It may still be trapped, it may still be weak. The sector may still not have enough demand. A higher price after confirmation can be better because it tells you the market has changed. That is how trained money often thinks. It is not trying to look clever by buying the absolute low. It is trying to participate when the odds have improved. That does not mean breakouts always work. They do not. That is why risk management matters more than opinion. The second area is critical minerals, mining, and the materials that sit underneath electrification, energy storage, defense, and AI infrastructure. This area sounds dull until you understand the demand chain. The world is becoming more electric. Electric vehicles need lithium and other battery materials. Batteries need minerals. Solar and wind need storage because the sun does not shine at night and the wind does not blow on command. Modern grids need upgrading. Defense systems need specialized materials. Data centers need power, cooling, wiring, equipment, and infrastructure. All of that depends on physical inputs. People like to talk about software because software is clean and easy to imagine. But the world still runs on materials. There is no AI boom without electricity. There is no electricity build-out without grids. There is no grid modernization without metals and minerals. There is no energy security without supply chains. And there is no national security if a country becomes dependent on rivals for the materials required to run its own economy. That is why governments are becoming more involved in domestic mineral supply chains when the state begins to care about a resource for strategic reasons. The investment logic changes. It is no longer only private demand. It can become policy-supported demand that does not remove risk. It can create new political and regulatory risks, but it also means the sector may receive a kind of tailwind that did not exist before. One company in this part of the market is SQM, Sociedad Química y Minera de Chile. It is a major lithium producer and sits inside a part of the world that matters for battery supply. The attraction is not simply that lithium is an interesting word. Many people have lost money buying interesting words at the wrong time. The attraction is that lithium is part of a real demand chain, and the stock can become interesting when the sector, fundamentals, and price action begin to align. If a stock like this has moved sideways and begins to approach a prior high, I do not want to guess in advance. I want to watch whether it can break through that level. A prior high is not just a number. It is a place where sellers previously had enough force to stop the move. If the stock moves above it and holds, that can tell you the sellers are weaker and the buyers are stronger. Again, that is not certainty. It is probability, and in investing, probabilities are what you manage. Another name is UEC, Uranium Energy Corp. Uranium is important because nuclear power is becoming part of the conversation. Again, AI data centers need reliable baseload power. Countries want energy that is secure and not dependent on unstable foreign supply. Nuclear energy is controversial, but it is also difficult to ignore when demand for electricity rises sharply. UEC has been connected to new production in the United States, and that matters because domestic uranium supply has a national security element. The key with a name like this is patience. It may have had a major move, then a collapse, then a period where lows begin to rise. That can be the early sign of a base forming, but early is not the same as ready. A watch list exists for a reason. It allows you to observe without acting. A poor investor feels pressure to act because he has found an idea. A disciplined investor can say, "This is interesting, but it has not yet met my rules." That difference is often the difference between speculation and process. Another name in the minerals and rare earth area is CMP. Again, the principle is the same. You do not simply say minerals are important and therefore buy anything with mineral exposure. That is not enough. You ask whether the sector has a tailwind. You ask whether the company is in the right part of the value chain. You ask whether price behavior is improving. You ask where the prior resistance sits, and you ask what has to happen before you would be interested. If that level is higher than today's price, that does not make the idea worse. It may make it cleaner. People are taught to believe the best investors buy things when they look cheap. Sometimes that is true, but in tactical sector rotation, the issue is often not cheapness alone. It is confirmation. The question is whether money is entering the sector with enough force to change the trend. There are two mistakes people make here. One mistake is buying too early because the story sounds good. The other mistake is buying too late because they wait until the story is obvious to everyone. The process tries to sit between those mistakes. You identify the macro reason, you identify the sector flow, you identify the leaders, then you wait for confirmation and manage risk. That is how you turn an opinion into a system. And the system is more important than the opinion. Now let us talk about how money should actually be put to work, because this is where many people hurt themselves. A theme can be right and a trade can still be wrong. That is a very important principle. You can understand the energy infrastructure theme correctly and still lose money if you buy the wrong company, pay the wrong price, concentrate too much, or fail to control risk. You can understand critical minerals correctly and still lose money if you chase a weak name after a huge move. Being right about the big picture is not enough. You have to survive the path. The first rule is position sizing. I do not want one idea to be able to damage the whole portfolio if I am wrong. I want the cost of being wrong to be acceptable. That is why risk is not the same thing as position size. A position might be larger than the amount I am truly risking if I have a defined exit and a disciplined process. What matters is the amount I can lose if the idea fails, for many tactical positions. Thinking in terms of a small percentage of portfolio risk can help prevent emotional decision-making. The goal is not to avoid losses. That is impossible. The goal is to make losses small enough that they do not impair the system. You also do not need to buy individual stocks if you do not understand them. Sometimes a basket, an ETF, or a broader exposure can be more appropriate. Individual names can produce larger gains, but they also carry company-specific risks. A broader vehicle can reduce that specific risk, although it may also dilute the upside. That is a trade-off. Every decision is a trade-off. You can also scale into positions rather than putting a large amount of capital to work all at once. Scaling is useful because it respects uncertainty. You do not know whether the first entry is perfect. You do not know whether the breakout will hold. You do not know whether the sector will continue to attract money. So you build as evidence improves. That is how a rational investor behaves in an uncertain system. The market is not one thing. This is one of the biggest ideas most investors miss. The news talks as if the market went up or the market went down, but inside the market, capital is constantly moving across a chessboard of sectors: technology, software, energy, oil and gas services, uranium, critical minerals, gold miners, construction, insurance, healthcare, electronic components, defense, banks, utilities. Money moves from one square to another. When money leaves one crowded place, it does not disappear. It usually looks for another place with better odds. That is why an index can look flat while certain sectors are doing extremely well. That is why a person staring only at the S&P 500 may feel nothing is happening, while a person watching sector flows can see major changes below the surface. The surface is the headline. The flows are the story. The mistake is to believe the market is only the headline. If the SP is down, people say the market is bad. But the question is, bad for whom? Bad for which sectors? Bad for which factor exposures? Bad for which crowded trade? There are periods when mega-cap technology is weak, but energy services are strong. There are periods when indexes are flat, but industrial infrastructure is rising. There are periods when the popular trade is tired and the ignored trade is beginning. That is why following money is more useful than following noise. The process does not require you to be smarter than everyone else. It requires you to be more disciplined than most people. Most people want an answer. They want a ticker. They want someone to say, buy this. That is the wrong desire. The better desire is to understand the machine. When you understand the machine, you can update as conditions change. If the money leaves energy services, you do not marry the idea. If the money enters another sector with stronger evidence, you study that. If the macro weather changes, you change the close. That is how markets work. The biggest risk for retail investors is not that they lack information. They have more information than any generation in history. The biggest risk is that they lack a process for organizing information. Without a process, more information becomes more confusion. With a process, even a complex world becomes more manageable. The process I would use here is simple enough to remember. Look at the weather, look at the flows, look at the leaders, define the risk, wait for confirmation, scale with discipline, exit when the evidence changes. That is not exciting, but it is effective. And it is much better than waking up every morning and asking which famous stock everyone is talking about today. In this environment, energy infrastructure and critical minerals deserve attention because they sit at the intersection of several powerful forces: inflation, energy security, AI power demand, LNG infrastructure, supply chain independence. Defense needs, grid modernization, battery demand, nuclear energy, government financing, geopolitical risk. These are not separate stories. They are connected. When forces connect, the probability of capital flows increases. That does not mean every stock in those sectors will go up. It means the sectors deserve serious research. And if the sector deserves research, then the leaders inside the sector deserve a watch list. That is where names like BKR, NPK, SQM, UEC, and CMP enter the discussion. Not as blind recommendations, but as examples of the kinds of companies sitting near the flows. Some may already be moving. Some may still need confirmation. Some may fail. Some may become leaders. The process will tell you which is which over time. This is why patience matters. An investor who cannot wait for confirmation will always be tempted by stories. An investor who waits too long will always be late. The art is not in predicting perfectly. The art is in building a decision process that puts you in the right places when the odds improve and gets you out when the facts change. That is how I think about this market. Not as a casino, not as a popularity contest, not as a place where the loudest stock wins. I think of it as a system of capital flows responding to changing conditions. The quiet machine is always moving. It is moving through index construction. It is moving through passive flows. It is moving through institutional rotation. It is moving through energy security. It is moving through minerals, infrastructure, and government priorities. Most people will only see the result after it becomes obvious. The better approach is to study the forces before they become obvious. That does not make you certain, it makes you prepared. And in markets, being prepared is much more valuable than being excited. The important question is not whether you can predict the next 12 months perfectly. You cannot. The important question is whether you can observe the current environment, honestly identify where capital is moving, and manage your risk well enough to benefit if the move continues. That is the practical edge. The market is not required to reward you for watching the same names as everyone else. It tends to reward those who understand where the next imbalance is forming. Right now, the imbalance may not be in the places getting all the attention. It may be in the sectors that look boring until you understand why the world needs them. Oil and gas machinery, energy infrastructure, LNG, critical minerals, lithium, uranium, rare earths. These are not glamorous words for most retail investors, but capital does not care about glamour. Capital cares about demand, scarcity, policy, security, and returns. That is the lesson. If you want to think better in this market, stop asking only what the index did today. Ask what is happening underneath it. Ask which sectors are filling with money. Ask which leaders are emerging. Ask whether the price action confirms the thesis. Ask how much you can lose if you are wrong. And ask whether your portfolio is dressed for the weather you actually see, not the weather you wish existed. That is how you avoid being trapped by yesterday's playbook. That is how you stop treating the market like one giant object and start seeing it as a living system. That is how you follow the money. And if you can do that with discipline, without chasing, without gambling, and without pretending you know more than you do, you give yourself a much better chance of being on the right side of the next rotation.